If you're not using a Roth to build wealth, you're giving your money to the government like an idiot. Seriously, every year you're not maxing this account, you're lighting money on fire. This thing grows tax-free, withdraws tax-free, and if you know what you're doing, it can absolutely crush the market. I'm not here to sell you theory. I'm showing you my actual Roth, the exact stocks I own, the income strategies I run inside it, and how I'm turning this into $3.57 million in 11 years. Completely tax-free. This account is already outperforming the S&P 500, and I'm doing it while selling options for extra income, all within a Roth. If that sounds insane, it's because nobody taught you how to do it right. Most people never figure this out. That's why they stay broke. This video fixes that. Why the Roth is a cheat code. Most people treat the Roth like a boring retirement account. Safe, conservative, something you should do. That's why they miss the point. The Roth isn't a savings account. It's a legal tax shelter, a financial weapon. You put money in, it grows forever, and the government never touches a dime. You think rich people aren't using that to their advantage? They are, and you should be too. Let's get clear. You contribute with after-tax dollars, so the IRS already took their cut. But every dollar of growth, from dividends to compound returns to option profits, is yours 100% tax-free. When you retire, there's no tax bill, no surprises, just pure cash flow. And here's what almost nobody tells you. You can run advanced strategies like covered calls and the wheel strategy inside a Roth. That's right, some brokers let you trade options in these accounts. And here's the kicker. Every dollar of cash you generate from those trades is also tax-free. And Roths aren't just for young people. My mom is 82 and still benefits from hers. You can even pass Roth money down tax-free to your family if you do it right. The bottom line, if you're not maxing this account every year, you're not just falling behind, you're volunteering to lose. You think you're maxing out your Roth? You're not. Here's what most people don't get. You're not maxing out your Roth, you're just hitting the basic limit. If you're using a Roth IRA and putting in $7,000 or $8,000 a year, great. That's better than nothing. But that's not wealth building on steroids. That's slow drip investing. That's the system telling you this is all you're allowed to do, and you just nod and accept it. I don't play by those limits. I can't. I make too much to even qualify for a regular Roth anymore, so I use a Roth 401k. Same rules, same tax-free outcome, but I can put in $31,000 a year. That's what happens when you use power strategies that the IRS allows, but most people never understand. This isn't about status, it's about scale. If I can drop 4 times more into my Roth every year while you're capped at $7,000 or $8,000, guess who's pulling ahead? And let me be clear, the regular Roth IRA works. If that's what you have, max it out and move on. But if you've got the option to use a Roth 401k and you're not doing it, you're choosing to play small and you'll pay the price later. Let's go over my Roth's positions from smallest to largest. SCHD, solid yield, small position on purpose. SCHD is like the reliable guy who always shows up to work on time, doesn't cause drama, doesn't break records, just does its job. It's got a 3.99% dividend yield, a long history of consistent payouts, and decent price appreciation. That makes it a solid ETF, especially in a Roth, because those dividends are tax-free. So yes, I own SCHD, but I keep it small, real small. Why? Because I'm not building a portfolio to get a 4% paycheck in 30 years. I'm building for scale, and SCHD isn't going to take me there. Most people confuse stability for strategy. They overweight income plays like this, thinking they're playing it safe. What they're really doing is slowing themselves down. SCHD has its place. It's the dependable piece, the dividend cushion. But let's not kid ourselves. This isn't a wealth engine. It's a sidecar compared to what I do, and I treat it like one. The goal is freedom, not a $400 monthly dividend check when you're 65 years old. Next up, JEPQ is a tech income machine, if you can handle it. Everyone loves the yield, but most don't understand what they're actually holding. JEPQ isn't just some high-yield tech ETF. It's a tech-powered income machine that lives and dies by market sentiment. And when tech is hot, this thing rips. Let's talk actual results. And remember, total return includes the dividends. The 3-year total return, JEPQ is up 50.99% versus the S&P 500, which is up 41.91%. Over 1 year, JEBQ is up 7.76%, the S&P 500 9.18%, and year to date, JEBQ is down 4.85% and the S&P 500 is down 3.7%. So if you believe in tech long-term like I do, JEBQ's volatility is a feature, not a bug, but don't mistake it for a bond replacement. This is a tech-heavy income play with real drawdown risk. Here's where it gets smart. That 11% dividend yield, most people get crushed on taxes because it's taxed like regular income. But inside a Roth, every penny is yours. No taxes, no paperwork, just cash. So yes, I hold JEBQ, not just for yield, for growth too. It gives me consistent income now with upside when tech runs. And inside my Roth, it delivers both without the IRS touching a cent. If you don't believe in tech, skip JEBQ. But if you do, and you want your income untaxed and aggressive, this one's hard to beat. VU and the triple Q equals stability and torque. Most people treat ETFs like a menu. Pick one and move on. I treat them like a toolbox. Each one has a job, and these two, they work together. VOO, or VU, gives me broad market exposure. It tracks the S&P 500, it's low cost, and it's built to compound quietly over decades. This is the foundation, the thing I could hand off to a trust and not worry about for 20 years. The triple QM is different. It's leaner. It tracks the NASDAQ 100, which means it's tech-heavy and growth-focused. This is my torque, the engine that pushes returns when innovation leads the market. Here's the point. I'm not choosing one over the other. I hold both because they serve different roles. VU gives me consistency when markets chop sideways. The triple QM gives me more performance when tech rips. And inside a Roth, that growth is weaponized. Every dollar of appreciation is tax-free, so when the triple QM goes vertical, I don't owe the IRS a cent. Most people don't think like this. They pick one ETF and hope. I build portfolios with intention, and this pairing, it's stability, upside, safety, and speed. You don't build wealth with random bets. You build it with assets that know their role and deliver. For SoFi, my thesis changed, so I'm out. So here's the deal with SoFi in my Roth. I'm liquidating the position. Why? Because my thesis changed. That's the main reason to exit a trade. I believed in the long-term potential and upside for SoFi, but that changed with the last earnings report, and I went from bullish to neutral. So I'm not holding it out of hope or ego, I'm moving on. But here's the part that matters. While I held SoFi, I sold covered calls on it. Inside my Roth, that gave me consistent tax-free income while I waited. So even on a position I'm dumping, I still squeezed value. Most people ride losers into the ground. I extract cash, then cut the cord. No emotion, just pure strategy. Most people think investing has to be exciting. It doesn't. It just has to work. That's why I hold SCHG, a broad-based growth ETF that compounds without chaos. And before you ask, yes, I already own VU and the triple QM. Here's how this is different. VU is the whole market, it's balanced and steady. The triple QM is concentrated in technology, higher risk, higher reward. SCHG is large cap growth across multiple sectors, tech, health, communications, but without being pure NASDAQ. SCHG gives me aggressive upside, but with more balance than the triple QM, and it's working. Over the past 5 years, SCHG has delivered a 25.72 average annual return. That's not speculation, that's results. Here's what I love. SCHG is a set it and forget it play. I don't need to trade it, I don't need to time it. It just compounds inside my Roth with zero tax drag. It's not flashy, it's not a trade, it's a long-term machine. Quiet, disciplined, and scalable. And if your entire portfolio feels like chaos, it's probably because you don't own enough assets like this. Now for my two largest holdings, Nvidia and Palantir. These two aren't just stock positions, they're income machines when the timing's right. I run the wheel strategy on both. That means I'm selling puts, getting assigned, then selling covered calls. Rinse, repeat. Each cycle spits out cash, and inside a Roth, that cash is all tax-free. But right now, I'm not running calls. Why? Because I expect a breakout when the trade war and tariff mess clears. If I cap my upside now with calls, I miss the run, so I'm just holding. That's what most people don't get. Timing matters, discipline matters. Covered calls are great until they limit you at the wrong time. You have to know when to hit pause, and that's where my Patreon helps. And when the market flips, I'll be right back in the cycle, pulling weekly premiums, compounding returns, and never paying $1 in taxes on it. This is how you use a Roth like a weapon. You don't just hold, you operate. 11 years from now, this account is worth $3.57 million when I'm 65 years old. And no, that's not hope, that's math. Right now, my Roth 401k is at $346,270. I contribute $31,000 a year, the standard plus catch-up. I'm self-employed and over 50, so I get the maximum contribution. I used a dividend calculator to project this, not because it's perfect, but because there's no solid Roth 401k calculator out there, and it still works. It factors in contributions and share price appreciation, which is what we care about. Now, here's where it gets fun. If I average 20% a year, which is aggressive, even though I'm actually doing better, this grows to $3,569,478 in 11 years. If I only hit 15%, it still hits $2,365,811. Either way, I win. But let's say I hit that $3.57 million mark and decide to coast. I could pull 10% a year, never touch principal, and live off $357,000 a year, 100% tax-free. Read that again. $357,000 per year, no taxes, just from this account. And that's just my Roth 401k and not even my full portfolio, which is much larger. This is the power of contribution plus compounding plus tax-free growth. Most people are gambling with stocks. I'm building freedom. At this point, you've got two choices. Option one, you do something. You take what I just showed you, set up your Roth or Roth 401k, start building it with intention, and stop giving the IRS more than they deserve. Or option two, you do nothing. You keep scrolling, you keep guessing, you keep waiting for the perfect time when inflation eats your cash and the market moves without you. 6 months from now, you'll either have a bigger Roth or another excuse. I've already built this into a 6-figure tax-free machine that's beating the market and growing towards $3.57 million. And I'm just getting started. Inside my Patreon, I show what I'm buying, selling, and holding in real time. How I use options to generate weekly income, the exact strategies that keep this account compounding. You can keep playing small or you can build something that lasts. But if you walk away from this video and do nothing, don't say you weren't told.